Hello, my name is Crystal Dahl, and I am the Online Communications Specialist here at Meritas. I would like to welcome and thank each of you for joining us on today's webinar, Latest Developments in Financial Services Law, a recap of key issues impacting all financial institutions that occurred in 2016, and what is next in 2017. Before we get started, I would like to quickly go over a few housekeeping items. Meritas now offers the ability to listen to our webinars through your computer speakers. If at any time you have any difficulty hearing the presentation, you may call into the associated telephone line instead. All phone lines will be muted. If you experience any technical difficulties, please press *0 at any time to connect with a support technician. I'm also available via the chat feature and can help you with anything that comes up. Since you will be muted, if you have a question, please ask via that chat feature found on the left-hand side of your screen. Lastly, in the next few days, I will distribute a copy of the presentation, a recording of the webinar, as well as each of the presenters' contact details. Our presenters today come from Krieg DeVault, one of the Meritas member firms in Indiana. Brett Ashton is the chair of the firm's Financial Institutions Practice Group and concentrates his practice on financial institutions matters. Mr. Ashton counsels banks and a wide variety of other financial institutions on all aspects of state and federal law and compliance with existing and developing regulations. Libby Goodnight focuses her work in the areas of general and commercial litigation with a significant emphasis on motion and appellate practice. Ms. Goodnight has experience and versatility in a wide range of litigation matters, including administrative law cases, shareholder, contract and other business disputes, covenants not to compete, trade secret enforcement, antitrust issues, RICO, financial institution litigation, securities fraud, constitutional claims, and class and collective actions, including those involving wage and hour issues and bank overdraft charges. And Lori Jean is a member of the firm's Financial Institutions Practice Group as well. She devotes her practice to counseling clients regarding corporate, transactional, and financial services law and compliance matters in the financial institutions industry. Welcome, guys. With that, Brett, are you ready to get started?
Thank you, Crystal. We are, and good afternoon, everybody. Thank you for joining us for our seminar this afternoon. In our time this afternoon, we're going to provide some information on recent developments in financial services law over the past year, including a high-level recap of the following issues: agency rulemaking, what new proposals were unveiled in 2016 that you should be aware of to advise your clients, regulatory enforcement actions, what areas did regulators focus on in 2016 from an enforcement perspective, and how to help your clients avoid becoming an enforcement statistic in 2017. Regulatory risks and opportunities. What were the common regulatory issues financial institutions struggled with in 2016, and how to address them in 2017, including a discussion of cybersecurity and high volatility commercial real estate. Additionally, a discussion of civil litigation trends. What are the latest litigation trends impacting financial institutions? Challenges involving website accessibility under the Americans with Disabilities Act, and a potential prohibition or limitation against mandatory arbitration clauses in certain consumer contracts. Finally, we will conclude our time this afternoon with a brief discussion of what to expect in 2017 and how a Trump presidency may change the outlook for financial institutions in the new year. Included in that discussion will be a brief discussion of the Financial Choice Act by Representative Jeb Hensarling, discussion of the PHH versus CFPB case, and whether President Trump will tell Richard Cordray you're fired, and a quick discussion of the OCC FinTech Charter, whether it's the beginning of the end for our state licensing system. with that, we have a lot to cover, so let's move into the discussion today. I apologize, we need to catch up on our slides. First, agency rulemaking. We'll start with some interagency rulemaking issues out there. First being the incentive-based compensation arrangements rulemaking that occurred in April of 2016, issued by all of the federal agencies. This rulemaking adds yet another layer of regulation to the ever-evolving issue of executive compensation by financial services firms. This notice of proposed rulemaking used a tiered approach based on the asset size of the institution, common to what we've seen in other regulations out of the various agencies. Many clients will fall into the level 3 category described below, which is inclusive of institutions with asset size of $1 billion to $50 billion. Level 1, of course, is $250 billion and above, and $250 billion, $250 billion. With that said, given the nature of prudential bank regulation, it is certainly expected the standards that are identified in this rulemaking will also flow down to institutions below $1 billion, if not as a mandate, as a best practice provided by regulators. We've included where possible in this slide deck links to every one of these regulations and rulemakings for your review. Very quickly, some highlights of the incentive-based compensation arrangement proposal include prohibiting types and features of incentive-based compensation arrangements that would encourage inappropriate risks because they're considered excessive or could lead to a material financial loss. Requiring incentive-based compensation arrangements to adhere to 3 basic principles. And again, these will not be that foreign to you given if you advise bank clients, given what we've seen from the agencies over the past few years. 1, a balance between risk and reward. 2, effective risk management and controls. And 3, effective governance. And finally, requires appropriate board of directors or committee oversight and record keeping and disclosure to the appropriate agency. Included within the scope of incentive-based compensation is any variable compensation, fees or benefits that serve as an incentive or reward for performance. Among the requirements for level 3 covered financial institutions, again, those institutions of $1 billion to $50 billion, are requirements that these institutions annually create and maintain for a period of 7 years records that document the structure of all incentive-based compensation arrangements and demonstrate compliance with the requirements of the proposed rules. These records would include at a minimum copies of all incentive-based compensation plans, a record of who is subject to each plan, and a description of the plan itself and how it's compatible with effective risk management and controls. Further, the institution's board of directors or a committee they establish has to conduct ongoing oversight of this incentive-based compensation plan, ensure they approved incentive-based compensation arrangements for senior executive directors, including the amounts of all awards, and at the time of vesting payouts under those arrangements, and approval of any material exceptions or adjustments to these incentive-based compensation policies or arrangements. And of course, finally, level 3 covered financial institutions are prohibited from establishing or maintaining any type of incentive-based compensation arrangement that encourages inappropriate risks by providing a covered person with excessive compensation, fees, or benefits that could lead to a material financial loss. Very quickly, without getting into the weeds too much, I think as our listeners can probably see, every one of these regulations, unfortunately, is very lengthy and starts to have a long list of added requirements that we'll try to touch on quickly today, just to give you a flavor of what you need to be considering when counseling clients. But when trying to decide what's considered excessive compensation, proposed rule provides compensation fees and benefits are considered excessive when amounts paid are unreasonable or disproportionate to the value of the services performed by a covered person, taking into consideration all relevant factors, including but not limited to combined value of all compensation fees or benefits, compensation history of the person, financial condition of the covered financial institution, compensation practices at comparable covered institutions based on factors such as asset size, geographic location, and complexity of the covered institution's operations and asset size. And very quickly, let me just note, this is an issue, that last prong is an issue that I would urge you to consider or keep in mind when counseling smaller financial institutions. Oftentimes we will see banks in the $200, $300 million in asset size, and you need to be thinking as clients, and you need to be thinking about what do those compensation practices at your client, if they are in that size, if they are of that size, how do they compare to the others in the industry? Are you paying excessively high compensation compared to other financial services clients, banks, and others that are in your geographic footprint or doing the same kind of business as you are? If you're paying more significantly, that is a red flag to regulators. For post-employment benefits, the projected cost and benefit to the covered institution, and any connection between the covered person and any fraudulent act or omission, breach of trust or fiduciary duty or inside abuse. We'll go ahead and skip over the requirements for Level 1 and Level 2 institutions given time constraints, but they're there in the slide deck for you to see. If you do have clients in excess of $50 billion in assets, we'd urge you to look at those. Okay, next, very quickly, standards for assessing diversity policies and practices of entities regulated by the agencies. This is another reg that came out of, as practically all of these seem to have, out of the Dodd-Frank Act. Here we are, some 6, nearly 7 years down the road from Dodd-Frank, and we are still seeing regulations popping up out of that act. This is an interesting one when advising clients. So this is a regulation that is not mandatory, but it's something that you really need to think about and talk about with your financial services clients. In essence, there was a standard and a policy put out by the regulators in 2015 that was reinforced with an FAQ in 2016 with respect to the diversity policies within your institutions that you counsel. And the policy statement says that regulated entities' self-assessments of their diversity policies and practices are voluntary, and submissions of information regarding those self-assessments are also voluntary. With that said, given the ongoing emphasis on fair lending issues, disparate impact, and all the noise around that area of the law, certainly your attention to issues of diversity when counseling financial services clients is important. The policy statement also contemplates that a regulated entity should voluntarily provide information regarding a self-assessment to the director of the Office of Women and Minority Inclusion of your primary federal financial regulatory authority, and then publish that information pertaining to your efforts on its website. Notably, though, an entity's diversity policies and practices are not assessed by the financial regulator. So again, if you have a client, if you have a bank client that is being told by a regulator, by an examiner, that they plan on giving them a lower score on an exam based on their diversity policy, I'd urge you to second guess that, to ask that question as to whether or not that examiner has that authority. Turning the page to CFPB rulemaking. Certainly, the Consumer Financial Protection Bureau has been prolific in its rulemaking over the last 6 years. We're going to hit the very high points here today, given time constraints. But undoubtedly, the biggest and most controversial, perhaps one of the most controversial rules to come out of the CFPB in some time, was their notice of proposed rulemaking on payday vehicle title and certain high-cost installment loans that was released earlier this year, commonly known as the payday lending rule. Common misconception is that this rule only applies to payday lenders. Certainly, if you have clients that you counsel that are engaged in the consumer finance industry, in the marketplace lending industry, in direct lending of any kind that is involving smaller dollar loans, this is one that you want to pay attention to, and I'd urge you to take a quick look. It's about 1,500 pages long. The key issue here to consider, though, is that this regulation creates a new definition under Federal Regulation Z that defines something called the total cost of credit. And the result of that is that the trigger for what is considered a higher cost or protected loan is significantly lower. There are more things that will be included in the scope of calculating a finance charge and an APR as a result that certainly when applied to the consequences for making a higher cost loan become significant. One point of note, and we'll touch on this when we get to the end of the presentation, given the change in administration about to occur in Washington, D.C., the future of this regulation is uncertain. However, if it were to be adopted as it is proposed, undoubtedly, it would force a vast majority of traditional true payday lenders out of the marketplace and see a reshaping of the small dollar and small consumer finance industry as we know it. Next, CFPB's arbitration rule. I'm going to skip over this. My partner, Libby Goodnight, will be commenting on this in a little more detail later in the presentation. However, we would just note that regulation, as you will hear, has a significant impact on all financial services companies and is likely to be finalized before President Obama leaves office. And then finally for CFPB, the prepaid accounts under the Electronic Fund Transfer Act, a significant regulation if you have clients in the prepaid space, in the gift card space, any kind of pre-authorized debit industry. I'd urge you to look at that as well. It's another lengthy regulation that you need to consider. Next, FinCEN. As you will hear from my partner, Lori Jean, in a moment, the issues of identity theft, cybersecurity, and general concern about bad actors in the financial services industry has only gotten worse in the last 12 months. We have seen in 2016 the finalization of the customer due diligence rule from FinCEN, or is commonly known the beneficial ownership rule. The key issue here for you to remember when counseling clients is clients need to ensure that they know who they're doing business with. That is true for clients that are doing business directly with an individual, directly with a company, or doing business with a company who's doing business with a company. When we get into third-party originator, third-party sender situations, for payment processors, payroll providers, et cetera, the scrutiny that regulators are providing to these folks is significant. So that's what's driven the added customer due diligence rule. And in essence, what it does is it adds a fifth pillar to the anti-money laundering program for a financial institution. Realize we have right now the requirement. You've got policies, procedures, and internal controls in place. You have independent testing, a designated compliance official focusing on AML, BSA, and employee training. However, this regulation will further require you to create customer risk profiles and perform ongoing monitoring to identify and report suspicious activity and update customer information. The key concern or key issue here becomes who really is your customer. If an individual, John Smith, walks into a bank branch, it's pretty easy to know who John Smith is. If John Smith walks into a bank branch and he is a member of a 5-person LLC, you need to ensure that you're telling your clients who are the beneficial owners of this entity. A beneficial owner under this rule is any individual who owns directly or indirectly equal to or greater than 25% of the legal entity's equity interest. Next. Quickly, because I know my time is starting to draw a little tight, the OCC, and we'll talk on this further here in a moment at the end of the presentation. Very briefly, the OCC just recently announced their special purpose national bank charter proposal for the fintech industry following a request for information earlier in 2016. In essence, this would create a specialized bank charter that would allow the fintechs, when we say fintech, it is a very loosely defined term. I think anyone who has a computer and an internet line thinks that they're a fintech if they're loaning somebody money these days. It would allow the OCC to provide a national charter to companies that met the standards that they have put forth. More on that later. Another significant regulation to make sure you are tracking and at least making sure your clients are aware of and on top of. Department of Defense's Military Lending Act interpretive rule. This was finalized back in 2015 but didn't become effective until October of this year. The DoD then issued a subsequent interpretive rule to answer all the questions that they failed to answer in the initial regulation that they put out. If you have any clients who are doing business with members of the military, or really if there's any chance they could do business with members of the military, this is an important one to make sure that if you're not advising them, they have a qualified compliance consultant that gives them the policies and procedures to ensure compliance. The Military Lending Act will require folks to ensure that they're scrubbing their customer base against Department of Defense databases to ensure they are aware when they are lending to members of the military. There are some restrictions that apply to loans that are made to members of the military over a certain percentage limit, and the calculation of annual percentage rate under this act is very different to what you see under various state laws that created a specialized military APR. Again, we could probably spend a whole session just talking on this reg alone, but if you have clients, especially in the geographic footprint of bases, military bases, I would urge you to take a look at that. Okay, switching gears quickly. Regulatory enforcement actions. We're going to move through this relatively quickly. CFPB engaged in no less than 36 enforcement actions in 2016. And I'd urge you to take a look at the link there. If you practice in the financial services industry, period, I would urge you to pull up the CFP website on a pretty frequent basis. Take a look under their newsroom tab. The Bureau publishes their enforcement actions quite gleefully every single opportunity they get, and it is a pretty steady stream of actions that they've taken. In 2016, most of the actions we saw were focused on the non-depository side. Again, we saw actions against payment processors, pawnbrokers, title lenders, student loan servicers, check cashers, and auto finance companies. A lot of activity also around the issue of debt collection and loan servicing. And we'll talk a little bit here in a moment about how you can counsel your clients to try ensure that they're not getting caught up in one of these actions. But I think the leave behind with respect to the CFPB's enforcement activity is that they have been extremely aggressive. They have stepped into what many would consider gray areas of the law, in some cases applying interpretations of the law contrary to those taken by other federal agencies, and in a retroactive manner in the case of the PHH versus CFPB matter. And generally speaking, we tell clients at least being cautious is the best course of action if you're dealing with an issue where the law maybe isn't as clear as it should be. Very quickly, there were two significant actions. There were several actions involving depositories this year, but there were two significant actions involving depository institutions. I think it would be very difficult for you to turn on the TV in the last 3, 4, 5 months and not be aware of the enforcement action against Wells Fargo Bank. As many people are aware, Wells Fargo entered into a consent decree with the Bureau and others based on claims they were engaged in opening deposit accounts and transferring funds without authorization, sometimes resulting in insufficient funds fees, applying for credit card accounts without consumers' knowledge or consent, leading to annual fees and associated finance or interest charges and late fees. Also issuing and activating debit cards, creating PINs, and creating phony email addresses to enroll consumers. The underlying issue here in this case was an allegation that there was a rampant culture of forced cross-selling in the bank and throughout the organization that forced some of the individuals, some of the employees to engage in this fraudulent activity. The end result of this is, in addition to refunding consumers all the money that they had lost as a result of this activity, the Bureau levied a $100 million civil money penalty against Wells Fargo. Next, lest the credit union industry thinks that they're immune from the scope of the Bureau, in the matter of Navy Federal Credit Union, Navy Federal entered into a consent decree with the Bureau based on claims that they had falsely threatened legal action and wage garnishment, falsely threatened to contact commanding officers to pressure service members to repay. Notably, if you take a look at these consent decrees, and I would urge anyone who has clients in this space to do so, notably, Navy Federal and others who have been subject to enforcement actions by the Bureau actually obtained written permission from the borrowers to allow the credit union to contact their commanding officers. So this was a bargain for and agreed upon contractual provision that the credit union obtained from their customer, and regardless, the Bureau went ahead and found this to be an abusive activity. Additionally, misrepresented credit consequences of falling behind on a loan, illegally froze members' accesses to their accounts. Navy Federal had implemented a process whereby if you were not paying on your loan, they would freeze access to your deposit account, which opens up several other issues, I think. So, end result here, $23 million in customer restitution, $5.5 million in a civil money penalty to the Bureau. And then, not to be forgotten, of course, one of, and there's several this year, but one of the main disparate impact / discriminatory cases out there with respect to mortgages. Department of Justice and the CFPB brought a significant action against Bancorp South this year, and with allegations of abusive sales practices, planned discriminatory action based on the willingness of staff to go ahead and assist protected classes, and frankly, all of the things that you read in these actions typically. Unfortunately, the allegation at least is that Bank South engaged in that. So moving on here, what are the lessons learned out of this? So if you're fortunate enough not to have a client that's gone through this horrible experience, how do you make sure that they don't going forward? So here are the takeaways, and we preach this to clients all the time. Development, implementation, and adherence to a compliance management system is important. And this is true whether you are a $50 billion bank holding company or you are a $1 million debt collection company. Debt collectors, by the way, are front and center on the radar screen for the CFPB. You need to make sure you've got a documented compliance policy, a process established where you are making sure you are in compliance with all state and federal laws. 2, stay abreast of the latest enforcement trends. CFPB has a bad habit of creating policy based on enforcement actions. It may not be in the statute, it may not be in the rule, but it sure could be in an enforcement action the Bureau just put out there. And if you don't know about it, your clients won't. And finally, tell your clients to engage in an ongoing and critical audit process to find those issues before the regulators do. Oftentimes, we will see clients that will come to us with issues, and typically, if we could have identified the issue before the regulator walked in the door, it's something we could have fixed and then presented the story to the regulator in a much more favorable light. So have your own auditors find the problem before your regulator does. And if you do find it and it's something significant, talk to your regulator and find a way to make sure that you can disclose it appropriately and minimize your risk. With that, we're going to change gears now and talk about the issue of cybersecurity, and I'm going to pass the baton on to my partner, Lori Jean.
Thank you, Brett. So looking at 2016, I think that it's taught us that there are many things that we can't predict, including our presidential elections perhaps, but other things that we can't, that one thing that we can predict, it seems with better certainty, is that the likelihood of a security breach is no longer an if, but a when. So we have much more unfortunate certainty around that, with the Russians hacking our computer systems potentially and affecting elections from the Panama Papers earlier this year. So at this point, cybersecurity has moved to, well, so what do you do when it happens? In 2014, the top target of hackers were financial institutions. And in 2015, the good news is, I guess, that if you're in healthcare, if you're in financial institutions, the good news is that in 2015, number 1, healthcare was the top target. Manufacturing was number 2, and financial services moved to 3. So still in a precarious and targeted position with respect to hacking and cyber events. So let's take a look. I think that the other thing we got in 2016 is the focus that consumers, regulators, shareholders, business partners are increasingly scrutinizing whether organizations that suffer a data breach, whether those organizations have adequate security before the breach, and they're also looking and critically examining how an organization prepares for, investigates, and responds to security incidents and breaches. And what we've seen are situations where the stakeholders believe that the organization's preparedness was inadequate. Those have led to litigation, regulatory investigation, certainly erosion of customer base, and changes in management. And I just kind of called out Target, Sally Beauty, Yahoo with 500 million records breached this year. So that's sort of the scope and where the status of things are. And that points to, I think 2016 became a year where preparedness, and I think even more so 2017, will be the catchphrase for what we see with respect to our clients in cybersecurity. So what are the high points of preparedness? And these are the items you see in front of you that I'd like to comment on today. Starting with, you need to know the legal and regulatory landscape. So let's just go ahead and start there. On the federal level, Cybersecurity Information Sharing Act is probably one of the most recent of the legislation. This provides a framework for sharing information between the private sector and the government related to cybersecurity threats and breaches. It's really more than anything enabling and providing evidence to the government to pursue cybersecurity violators. But more significantly for our clients is what's happening on the state level. In 2016, 27 different states introduced legislation. The focus of that was wide and varying, the bulleted items that you see there. Most significant being that 26 states adopted notification requirements, which brings the grand total to 47 states plus the District of Columbia, which currently have breach notification legislation on the books. Only Alabama, New Mexico, and South Dakota do not. So if you are fortunate enough to have clients who are focused in Alabama, New Mexico, and South Dakota and don't have any customers in any other states, you're in good shape. If you have clients with customers in any of those other states, and each state in which they have customers, you need to be aware of what is happening on the state level with respect to legislation. There have been numerous federal laws proposed with respect to coming up with comprehensive federal legislation to address notification. Talk has been going of these since 2010. We've had legislation proposed year after year. Nothing is in sight at this point. So until that happens, you need to know the law of each jurisdiction in which your client operates or has customers. So the next element of preparedness, this is good old-fashioned risk assessment, something that all of our financial services clients should be well aware of and used to. But risk assessment, not just at the high level, enterprise level, but specific focused cybersecurity risk assessment is the expectation. In 2015, the FFIEC came out with its cybersecurity assessment tool, and this is a handy tool to help our clients identify the various cyber risks, and it's also useful to help them assess their controls. What controls do they have in place? And based on their assessment of the controls in place, they are then assigned a cybersecurity maturity level. Basically, do your controls match your risks? And if not, the benefit of this tool is it provides a very handy way to see what you would need to do in terms of adding control to make sure that that maturity level measures up to and matches your risk level. It's not mandatory that this be used, but as with regulatory creep, what we've seen in 2016 is that the regulators are looking to see who is using this. It's been part of the 2016 exam cycle, and we think that will only be continuing in 2017. It is a useful tool, so something that if your clients aren't using, you may want to point them in that direction. Also related to risk assessment is another something, not necessarily something new, but something receiving new focus in the context of cybersecurity. Vendor management, now better known as third-party risk management, is an area in which the regulators are pinning their hats for financial institutions, a place for them to make sure that they're appropriately managing the cybersecurity risk introduced by the use of vendors in the operation of the institution. So common elements of third-party risk management are first the due diligence step. And what your clients ought to be doing here is evaluating each vendor's cybersecurity vulnerabilities and preparedness. So getting your SOC 2 Type 2s and checking to see that they are able to protect sensitive data. because just because the client is outsourcing a portion of their some service, maybe they've got some of their treasury services outsourced, or perhaps, they're using a third-party core provider. The financial institutions vendors must nevertheless be able to protect sensitive data with the same level of care that the financial institution is held to in protecting that data. So to that extent, the due diligence has to be done up front, and then there are expectations that certain contractual protections will also be negotiated with the vendors, again, to ensure they can protect the data. So these would be the obligations to provide periodic SOC 2 Type 2s and other types of security reports, to ensure that they are able and contractually obligated to provide necessary information to enable the institution to comply with its notification requirements. Other provisions that you'd want to see would be maintaining a right to audit the vendor and shifting liability to the vendor for any breaches that are due to the vendor's inadequacy in protecting the information. So, not necessarily new, but 2016 and 2017, I think an area where we see financial institutions maybe not being where they need to be, particularly for the smaller, are having appropriate policies and programs in place. And these should be focused on two elements that you tend to see in a written information security program, and those are both prevention and incident and breach response. It's interesting to note, again, taking us back to how important those state statutes are. Rhode Island and Massachusetts, their statutes specify that if a company owns or licenses personally identifiable information about a resident of those states, they must have a written information security program in place, or a WISP. And they also contain certain elements that that program must contain. So let's take a look. What are some of the common elements in a WISP, or a written information security program? Fundamentally, the risk assessment, which we've already talked about, a data map. This is so fundamental. You need to know what you have in terms of data, where is it stored, and how does it move both within and outside of the organization. If you don't know what you have and where it is, how do you know when it's gone and how to protect it? So an essential element there, and a much bigger task, I think, than many realize. Then necessarily you need to specify the safeguards for that data, these being both physical, technical, and administrative. Things along the lines of having strong password policies, periodic changes of passwords, that's all table stakes, that's basic stuff. But more fundamentally, being able to address other issues such as need to know who gets access and who takes access away when someone leaves. So those are the types of things that you would expect to see in the WISP program addressed. Not to mention other important things such as restricting remote access. So not only to employees, but vendors who need to access the financial institution systems. How are those things managed? Also key, having a single person responsible for those policies. Interestingly, when I talk later about cyber insurance, there's the Ponemon Institute has quantified the cost of a data breach. And I'll come back to that, but it's roughly $156 per record stolen or lost. And they have identified that simply having a single person identified as an employee responsible for your policies and procedures, I don't know how they figure this out, but they say it reduces your cost per data record lost by $7. And employee training takes it down $9 per record. So I think it's very fascinating that they can get down to that level of granularity. But they tie back the cost of the data breaches to having these elements in place. The one other I'd like to comment about is data destruction. Records retention policies and destruction really are never been more important. The more unnecessary data that you have around, the greater the cost of any breach. So records retention is very difficult for many organizations, and we tend to see people keeping everything out of fear of not knowing what they can and cannot keep, but it's never been more important than now for organizations to cull unneeded data and to get rid of all that information to reduce their risk and their costs in the event of a breach. Other items, proper disposal of used and obsolete equipment are things that you would expect because, again, that copy machine with all of the information stored on the chip would be a good thing to get rid of. So that's the level of granularity expected in these written information security programs. So let's turn to the other side. This is not the if but the when, the incident and breach response plan. This plan needs to address a number of key elements, including how the organization addresses a security event versus an incident versus a breach. And events and incidents aren't necessarily defined, but an event is generally more so along the lines of an attempt to obtain data or maybe a situation in which data could theoretically be exposed. So maybe a phishing email that gets caught in a spam filter is a security event, but not necessarily one that requires an escalation or particular attention because your technical safeguard has caught it and taken care of it. An incident, that's something a little bit more serious and might require an escalation. But if your employees in the institution don't know the difference between an event, an incident, and a breach, which is key because breach is often statutorily defined and the trigger for notification and other requirements. So it becomes imperative that these items be clearly defined and understood within the organization. And likewise, what is the chain of escalation? Who is responsible for investigation and reporting? And this is one where in-house counsel plays a very important role. Who the response team is very important because once you get into this level where you're dealing with a breach, then things become important, like record keeping, because for future regulatory exams or potential litigation, you want to have had a record. Again, there is greater exposure for litigation, greater exposure for liability if you do not have a plan and you are not prepared, sort of what I talked about in the very beginning. And then finally, very important for any plan is to be certain that it provides for periodic testing, doing simulated events, and continuous improvement of the plan to reflect new risks that are out there. There are websites available to the financial services industry and others where different threats are cataloged and you can keep up to date with, and then your response plan likewise needs to be kept current for personnel changes, changes in legal requirements. So the other area that I think is key, how am I doing here? Keep going. All right. Trying to keep it moving. The other area that I think will be very important for 2017 as a look forward is the area of cyber insurance. The 2016 Ponemon Institute report, and this is published annually, you find this out on the internet, it's Ponemon. They put out their average cost of breaches and their cost per record breached. Their 2016 report gave an average cost of a data breach of $4 million. Their assumption is 10,000 or more records being breached, but that's their average cost. It's very interesting in that it's $156 per record is on average. For a financial institution, on average, it's $221 cost to the institution to deal with a cyber breach, and if you're in healthcare, $355 per record. So if you're dealing with 10,000 records, how many customers, how many clients, how many different data points do you have that have been taken? This can add up quite quickly. So cyber insurance, I think, is an area of focus. The data breach litigation report in April of 2016 reported that only about 31% of companies currently have a separate cyber policy. What we're seeing more so is that companies are relying on endorsements to their property and casualty policies, and frankly, these are just not sufficient. Very often, the coverage provided is only a sliver, a very slim area that's usually covered. What you tend to see is perhaps the cost to restore data being covered by such a policy, but not in other areas. And I'll get to that when I talk about scope of coverage. Instead, what is advisable is to have a separate cyber policy that is a primary policy that responds first. That is, you don't have to turn to professional liability or property and casualty for coverage. Let's talk a bit about what a cyber policy, the key points are. So with a cyber policy, as with any, scope of coverage and exclusion are critical. A lot of cyber policies will have limitations. So for example, it's sort of like healthcare. Is it a pre-existing condition, a pre-existing problem? For example, if you have a virus already in your system at the time the policy becomes effective, it may not be covered. Also interesting in terms of scope of coverage, you want to look, does it cover your cost of investigation? What if you need to bring in an outside forensics expert? Is that on your dime, or does the policy cover it? Consumer notification costs, are those covered? What about you decide to offer credit monitoring to consumers who've been impacted? Does the policy cover that? And any number of other items that you might want to consider being part of your coverage, depending on the nature of the client, the size, and the nature of the breach potential. So those are very important elements for you to assist your clients with as you're negotiating and looking at cyber policies. What about cost and coverage limits? Again, this becomes very individual to the particular client, but I can just give some shared statistics here. So for your average, not particularly complex organization, I've seen numbers in the range of anywhere from $500 to $7,500 for $1 million in coverage. Again, that's kind of, you're not sure what you're comparing because what's the scope of the coverage. But I've also seen quoted $40,000 to $60,000 for $2 to $3 million in coverage for a more sophisticated organization with more data. Now, those numbers are interesting because, again, what I gave you in the beginning was the average cost of breach being about $4 million. So those, I think, will be somewhat difficult to quantify, very client-specific, but an area in which our clients will need direction as we move into 2017. With that, I'm going to turn over, I guess, to me. I keep going. All right, I'm next again. All right. I will now focus on high volatility commercial real estate. This is an outgrowth of the Basel International Accords, and HVCRE this became effective back in January 1 of 2015, but we're still continuing to see some uncertainty. We'd had some clarification come out in the form of FAQs on this, and there are just a number of questions that we see continuing to come up, so we thought it would be a valuable item to address at this point. So what is it? It is a classification exposure for risk weighting that's used to determine a financial institution's requirements for their minimum capital. So that's what Basel III sets. And what we're not sure about going forward, though, is what the future of Basel III is. Basel III was an output, was an outgrowth of the 2008 financial crisis, and the sort of general recognition that internationally capital requirements should perhaps be something that we're looking at a broader worldwide basis. Trump has made some rather opaque comments that some have interpreted as being directed at Basel III. So it's uncertain whether Basel will be unraveled, because it's actually one of the few things post-2008 crisis that's sort of finally starting to settle and come to the end of its rulemaking. But I guess all we can say there is, stay tuned to Twitter. Other than that, so let's take a look at, assuming its continued viability, let's take a look at some of the details. So why does it matter? The HVCRE classification matters in both to lenders and to borrowers because it does, here's the bottom line impact. Risk weighting for real estate secured loans is generally at 100%, multifamily at 50%, but if a loan gets classified as an HBCRE, it's 150%. And the impact of this higher risk weighting is that for the bank, higher capital is required with respect to these types of loans, and it's therefore of a higher cost to the lender. And then in turn, this higher cost may be passed along to the buyer either in the form of higher interest rates, a lesser availability of these loans, or an increased cost in terms of indemnity liability. So that's why the goal with respect to these loans is to avoid them and avoid this classification. So what types of loans does it apply to? Let's look at that. So this HBCRE classification applies to any commercial real estate loan that is for the acquisition, development, or construction. And interestingly, the classification persists for the life of the project, and we'll come back to that. Now, the good news is that, well, let's take a little bit more depth into that. What types of these commercial real estate loans? There has been some additional guidance that has come out, and it points to the fact that it applies not only to loans made after but before the effective date, which was an open question at one point. So even though the effective date was January 1 of 15, this goes back. So the bank has to account for those other loans in its portfolio based on these capital requirements. It applies to land loans with no construction or development component unless permanent financing is in place that complies with the lender's general underwriting criteria and loan terms for permanent financing. It applies to any portion of a loan that is ADC, acquisition, development, or construction. And it also applies to loans with subsequent advance components if valuation is based on an as-completed value and there will be future advances. So ultimately, the goal is to stay out from under this classification. And you can do that in one of four ways. There are four exceptions. So if you happen to have 1 to 4 family residential properties, the loan qualifies as an investment in community development, ag loan. And the fourth exception is for loans that satisfy certain loan-to-value and equity requirements. And that's the exception that I'd like to focus on today. So this exception 4 has two elements. The first is the loan-to-value requirement. So that is that the loan-to-value must be less than or equal to the applicable maximum amount depending on what the loan type is. So I've got the loan type up there for you. So for example, if you're dealing with construction loan, that's commercial, multifamily, and other non-residential, 80% loan-to-value. Construction of 1 to 4 family residential, 85%. And so the other key is that the loan-to-value is determined at the time of loan closing or origination. So fairly straightforward. But let's look at the more interesting aspect of this, and that's the equity requirement. So there is a requirement that a borrower has contributed capital of at least 15% of the appraised as completed value. So I'm going to focus on that as completed component. So this is a higher standard than an as-is appraised value. It's less so, lower standard than an as stabilized. So it's focused on as completed. And then what qualifies as capital? Cash is always king. Unencumbered readily marketable assets. Paid out-of-pocket development expenses, basically your soft costs, can qualify as contributed capital, as can cash paid for the land. And what about what does not qualify? Well, this is another area where there's been some guidance provided. Borrowed money does not qualify. So if it's debt of the borrower, whether it's secured subordinated financing or unsecured debt, does not qualify. Other collateral that has been pledged in support of the loan does not qualify. Deposits. So for example, people put money down on the project, on their condo unit, on whatever it is, those deposits do not qualify as equity. Government grants do not qualify as equity. There's been an FAQ put out on this, and that's where these clarifications have come. So let's talk a little bit more about it. The next step is that the contribution of capital must be made prior to any loan advance. So basically that means at closing or origination. And then the most interesting requirement and the most onerous is the last, which is the capital contributed by the borrower or internally generated by the project is contractually required to remain in the project for the life of the project. So let's focus on that. So this restriction on distribution applies to all equity, even that contributed in excess of the 15% minimum. So think about that. What does that end up doing? That penalizes your conservative borrower, and it discourages better capitalized projects because that capital is stuck once it's put in. The restriction also applies, and this is the internally generated by the project part. What that means is, that means it applies to net operating income and any other distributable funds generated by the project. So what the effect is that traps both contributed capital and your net operating income in the project. Again, punishing that conservative borrower and resulting in a higher cost of capital. So what does life of the project mean? Because that's how long it's stuck. That has been explained to me until it's either the financing has either been converted to permanent financing, it's been paid in full, or it's been sold. So converted to perm, that's pretty straightforward. But it means converted to a permanent loan or conversion actually may occur within an existing loan itself, provided that that conversion is triggered by meeting the lender's normal lending terms and underwriting criteria. So that's another particular reason why avoiding that classification and trying to stay out is important. So how can you do that? Structuring loan documents, and here's where you come in to help your lending clients and your borrowers. How you structure the loan documents, you may be able to avoid the classification. So one way to do this is, if it's at all possible for the loan to be underwritten as a permanent loan and not on the basis of it being an ADC loan, if that's possible, by all means. Or another option would be to structure the credit facility as two separate loans. So if a portion can satisfy the permanent underwriting criteria, you may want to try to do that to stay out from the HBCRE classification. Another area where your advice can help your clients is with respect to closing conditions, to make sure you've got something to point to in your documents to say, hey, no, this is not HBCRE. You want to expressly state the loan to value must meet the threshold based on the as completed value. You'll also want to expressly state a condition of the amount required with respect to the equity contribution to make sure you meet that 15% or more. The covenants are also an important element that you have to address in the loan document. The rule requires express contractual language requiring the contributed and generated capital to remain in the project for its life. So that has to be in your loan documents. And then another area that you want to address is the issue of the consequence if they fail to keep the equity in. So the rule doesn't say that you've got to declare a default. So other than that, if that's not the way your lender wants to go, you may specify the consequence as being an increase in the interest rate, or increased cost indemnification provision. So those are elements that you would want to make sure you include in your loan documents. And also, it's probably advisable to include an acknowledgement that the regulations may change prior to loan maturity. So to the extent we see some adjustment in Basel, and it's possible to take advantage of that, you would want to reserve the ability to make that sort of a change. So with that, I will hand it over to my partner, Libby.
Thanks, Lori. I'm going to touch on today civil litigation trends impacting financial institutions, and I'm going to focus in particular on two developments that caught our eye in 2016 and are likely to impact financial institutions going into 2017 and beyond. The first being challenges involving website accessibility under the ADA, and the second development being the potential prohibition, or at least a significant limitation, against mandatory arbitration clauses in certain consumer contracts involving financial services and products. Apologize here while I get caught up on our slides. And Brett mentioned that during his. Now, accessibility under the ADA. If anybody's ever been involved in any sort of ADA guidance or litigation on behalf of your clients, you may know that Title III of the ADA prohibits discrimination against individuals on the basis of disability and the full and equal enjoyment of the goods, services, facilities, privileges, advantages, or accommodations of any place of public accommodation. This provision of Title III requires banks and other financial institutions that are open to the public to be accessible to individuals with disabilities because banks and financial institutions are considered quote-unquote places of public accommodation under the ADA. Now, in the traditional sense, we see these both as lawyers and as consumers of banking products is kind of the traditional brick and mortar office space and branch offices. You know, you see the handicap ramps, you see the accessible doors and those kinds of things. You see the ATMs that have the braille on them. And those are sort of what we think traditionally about accessibility under the ADA for financial institutions. But something has been sort of brewing and really come to a head in 2016 that we're going to continue to see more of, and that's something called website accessibility. It's another aspect of doing business that really creates more opportunities or more traps, depending on how you look at it, for potential exposure under the ADA. What is website accessibility? It's the notion that websites need to be accessible to individuals with disabilities. This arises usually in the context of vision impaired, although hearing impaired individuals as well can have a complaint that a website is inaccessible. For example, if you think about websites today where they might have a video component, where there's a video playing, that may impact a hearing impaired individual's ability to truly access that website. Vision impaired, there's a lot of software out there that allows both vision impaired and hearing impaired individuals to access the information, whether it's readers or magnifiers, websites that are compatible with Braille readers and things like that. Those are the types of things we're talking about when we talk about website accessibility. There's an international organization, a worldwide web consortium, that has recommended what is known in the industry as the Web Content Accessibility Guidelines. And these are a set of highly technical standards for web content accessibility. These are really sort of almost drilling down to the programming level, the software level of how websites should be built and programmed so that the websites are compatible with the type of software and capabilities needed for vision impaired and hearing impaired individuals to access the content on a web page or a website. Now, importantly, the website accessibility guidelines that have been adopted by the Worldwide Web Consortium, or at least recommended by the consortium, they're not the law. They have not been adopted expressly by the DOJ. There's nothing that makes those guidelines controlling, and the DOJ is still in the process of developing regulations for website accessibility. This really began back in 2010. The DOJ issued an advance notice of proposed rulemaking on web accessibility entitled The Non-Discrimination on the Basis of Disability, Accessibility of Web Information and Services of State and Local Government Entities and Public Accommodations. So Title II of the ADA is what governs accessibility of governmental agencies and municipalities. Title III is the public accommodation requirements for businesses, and the DOJ expressed at least its intent and interest in looking at this issue back in 2010. I think it's something that they've struggled with, frankly, after some of the comment period. I think cost may be a significant factor for a lot of businesses trying to build websites or promote their businesses. The cost associated with getting those websites compliant with some sort of standard. So it's taken a long time, and the DOJ recently announced that any final rulemaking, at least with respect to places of public accommodation, are probably not going to be completed before 2018. But that hasn't stopped the plaintiff's lawyers from focusing on this issue, and we'll talk a little bit about that in a moment. But absent DOJ guidance, there's already some case law out there that addresses the issue of website accessibility. Most often, the question that arises, at least from a litigation context, is whether or not a website can be a place of public accommodation. Given the wording of Title III of the ADA that I quoted from earlier, the focus is on places of public accommodation, and so the question is that has been addressed by a number of courts is whether a website can be a place of public accommodation that's even required to be accessible under the ADA, at least during this sort of gray period before the DOJ expressly adopts regulations that make it a requirement. There have been a handful of cases, relatively recent cases, that address this issue, and there are several cases that have come down on the side of concluding that websites do, in fact, need to be ADA accessible under Title III of the ADA. An interesting case, the National Federation of the Blind versus Target Corporation. This was a district court case out of California. This involved the ADA accessibility of Target.com, Target's website on which consumers can go online and purchase products from Target. The argument was made by Target that well, the website isn't a place of public accommodation, and therefore the complaint should be dismissed because there can be no liability under Title III of the ADA. Well, the court concluded that if you look at the language, it talks about services of a place of public accommodation, not services in a place of public accommodation. And given that Target, sort of the traditional brick and mortar store, is a place of public accommodation that happens to provide as part of its services, online services, it concluded that Target's website was in fact something that was required to be accessible under the ADA. And so sort of implicitly, or at least, or perhaps even directly, sort of made the link between the brick and mortar store and the website as justification for extending ADA liability to Target.com. Another case of interest is a recent case from the District Court of Massachusetts, National Association of the Deaf versus Netflix. And also another case, even more recently from Vermont, the National Federation of the Blind versus Scribd Inc. In both of those cases, the courts ultimately concluded that Title III of the ADA, again, did include websites within the scope of a public accommodation. Now, interestingly, those of you who are familiar with Netflix, Netflix is the type of vendor that's exclusively online. There is no brick and mortar place of public accommodation associated with Netflix. And so that was an interesting case in the sense that here is a court deciding that without any nexus to any sort of physical place of public accommodation, that a truly online retailer or provider of services to consumers could be subject to liability under Title III of the ADA for not having their website being ADA accessible. Of interest is that the DOJ filed a statement of interest brief in Netflix supporting the position that websites are within the scope of Title III protection. And so while the DOJ hasn't formally adopted regulations that dictate website accessibility under the ADA, they have expressed a clear interest and belief that they do believe websites need to be accessible. And so for all intents and purposes, we sort of need to be moving down the path of believing that the DOJ is going to be looking at this issue and enforcing this issue as soon as those regulations get in place, if not before. Another recent case that actually came down within the last couple of months, National Association of the Deaf versus Harvard University. This involved a case where an organization had sued Harvard University and MIT for not making their online audio and audiovisual content closed captioned, kind of going back to that issue of hearing impaired individuals needing to access web content. Again, the defendants tried to get out on motions to dismiss, and those were denied for similar reasons as some of the other cases that we've mentioned. And also of interest, they actually tried to stay the litigation pending the DOJ's promulgation of technical standards for website accessibility, and the court denied that request for a stay and basically took the position that courts interpret the ADA all the time and doesn't need the technical expertise of the DOJ to tell it whether or not a website is adequately accessible to someone who is hearing impaired. So that was sort of an interesting twist that the defendants took in that case to try to sort of prolong things, and the court ultimately concluded that whatever guidance the DOJ provides isn't going to really change the court's ability to analyze that issue. Financial institutions are probably a natural and obvious next big target with the proliferation of online banking and a lot more people, frankly, banking exclusively online. I can't remember the last time I walked into a bank branch, and there are probably a lot of people like that. And so it's natural for them to be the next big target after sort of the traditional online e-commerce consumer retailers. The absence of federal regulations, as I mentioned earlier, hasn't really stopped plaintiffs' lawyers from filing lawsuits or more often than not sending demand letters to companies challenging their inaccessible websites and trying to extract settlements from them. We have actually had personal experience with some of our particularly community banks, but frankly all banks here in Indiana who are getting demand letters from a handful of plaintiffs' lawyers who are sort of trolling around the country looking for banks who haven't met any accessibility standards on their websites and sending a demand letter and saying, if you don't do X, Y, Z, or if you don't pay our client a certain amount of money and make your website accessible, we will file suit. And so that we've seen that here in Indiana. In some of the research that I've done on this particular issue, I know that there are a number of states that are reporting similar issues. So if you are connected to your local state bankers association, they may be familiar and seeing these types of things. So it's certainly something to be on the lookout for. In terms of response strategies to demand letters, it's really tough to say because, as I mentioned earlier, there's such a gray area right now. There's no regulations. It's hard to know, what exactly to do and how to assess the risk there. Obviously, one alternative is to comply with the settlement demand. One thing that we're seeing more often than not is just trying to be proactive rather than using the funds that you might use to pay a plaintiff's lawyer a settlement, knowing that that's not actually going to make that plaintiff's lawyer go away because you're just going to find another client and another website. Devote those resources to making the website accessible. There are a lot of companies out there that can be hired to do audits of your website, of the bank's website, to determine where are the weak areas, what are some things that can be done to make your to the bank's website more accessible. My understanding is from the very technical website accessibility guidelines adopted by the International Consortium is that I believe there are also some different levels of accessibility, so certain levels of measures that can be taken from kind of a programming software perspective to make websites more accessible. So that may be something that you want to advise your banking clients on to sort of do an audit or reflect on whether or not they believe their website would meet at least the minimal standards for website accessibility, particularly to the vision and hearing impaired. So that's website accessibility under the ADA. The next topic that I want to talk about is the potential ban on mandatory arbitration clauses in consumer contracts that could preclude class litigation. Now, many of us are familiar, from personal experience to representing banking clients, that many contracts for consumer financial products and services include a mandatory arbitration clause. Typically requires that all disputes between the financial institution and the consumer be arbitrated. It generally blocks class action lawsuits in court and also prevents group claims in the arbitration process. Having been engaged in some class action litigation myself, we know that typically class action litigation ends when class certification goes away, if you're able to defeat class certification or avoid a class action altogether, because the likelihood of individual consumers bringing lawsuits against financial institutions is slim, and so in many respects that's sort of the practical benefits of including mandatory arbitration provisions in contracts. The Dodd-Frank Wall Street Reform and Consumer Protection Act seemed to take a dimmer view on that issue. It authorized the CFPB, which is the Consumer Protection branch that focuses on consumer issues in the financial industry, to study the use of mandatory arbitration clauses, and also then, upon conclusion of that study, promulgate regulations consistent with the findings of that study. The CFPB has taken a dim view of arbitration provisions. They announced in May of 2016 that it would be seeking comments on proposed rules that would prohibit mandatory arbitration clauses in contracts for consumer financial services and products. I've included here on this particular slide the website for an announcement regarding that effort, and it's clear that the CFPB takes a dim view of those arbitration provisions as reflected commentary, but also by virtue of the provisions that are going to be included in those proposed rules if it becomes the law. All providers of consumer financial products or services are going to be considered a provider under these proposed rules. I've identified some of the examples of the providers that would be covered by the proposed rules. This is not an exhaustive list, but the reality is if you look down this list, it pretty much covers any financial services institution or bank or credit union that extends credit to a consumer or provides a savings account, provides a credit card, and so the breadth of reach of the rules is going to extend pretty far. There are some limited exceptions to who is going to be governed by the new proposed rules regarding arbitration provisions. I've listed a few of those here: broker-dealers, local, federal, state governments that provide services directly to the consumer, smaller creditors, and merchants and retailers whose primary business is not the financial services industry, but extend credit in conjunction with some of the other things that they're doing for consumers. Now, mandatory arbitration clauses are not going to be banned entirely. The proposed rules do not limit the use of mandatory arbitration clauses in cases that are not class actions. And really the goal with these proposed rules is to eliminate the prohibition of class action litigation. And so that's really the focus or the purpose of the new proposed rules is to foster an environment in which class actions can occur, and really the theory, I guess, or the policy of the CFPB being when you have class action litigation, you're impacting the way an entire industry does business with all of its consumers, and you're more likely to change conduct. But arbitration would still be allowed in individual lawsuits, and so it's not banned entirely, but I think it does have a significant impact on how banks and financial institutions currently structure their mandatory arbitration clauses. If you do have some mandatory arbitration provisions in there, there's some added disclosures that are going to be required. The proposed rules actually have some very specific language about what is going to have to be included in consumer contracts. This first bullet point quote will be in contracts where the product is exclusively subject to the proposed rules. Sometimes you have contracts for financial services or products where some of the products may be covered by the proposed rule, but some products may not be. And so the second iteration of the disclosure language is really designed to cover that situation where some products may be covered, but some may not be. And again, this language again emphasizes the CFPB's policy that they're going to not prohibit class action litigation in these types of contracts. And the disclosure obligations are going to extend to existing consumer contracts, as the slide indicates. These are also, if you have a contract already in place where perhaps class action litigation is barred, the banks are either going to have to amend their contracts to include some new language, or they're going to have to send out new notifications disclosing a change to their existing contract. Also under the reporting, reporting will be required under the proposed rules. This is a desire by the CFPB to increase transparency. Again, one of the reasons why many banks and companies like arbitration is because it's difficult to track settlements. They're not publicly reported in the way lawsuits are in public filings in the court. And so even with arbitration provisions, there is going to be some mandatory reporting to the CFPB so that they can track what the trends are, what kinds of claims are being filed, what banks and financial institutions are making their way onto the naughty list. And so with that, I'm going to wrap up my civil litigation trends and turn it over to Brett for some closing remarks.
Thank you, Libby. As you all can see, we're almost out of time, and we really have just barely touched the treetops on the issues we've discussed today. There's a lot of material here, a lot going on in financial services, regulatory practice these days. I'm going to leave you with just these three issues, and if we have time for one question, we'll try to squeeze it in. But quickly, looking ahead, what are we going to face in the new year? Undoubtedly, with a Trump administration and Republican control of both houses in Congress, Chairman Jeb Hensarling from Texas, who chairs House Financial Services Committee in the House, has said he will be bringing back the Financial Choice Act. This bill is a laundry list of things that the financial services industry wants, including putting a board or a commission over the CFPB, getting rid of the SIFI designation under Dodd-Frank, and several other things. There is a possibility that Trump could have the power to fire Director Cordray on his first day in office. Take a look at the PHH case referenced there. A lot of stuff in that case, an enjoyable opinion to read if you don't like government overreach, as we've seen from the Bureau lately. The upshot of it is, though, that the D.C. Circuit Court went ahead and struck out the for-cause removal provision for the director of the CFPB. That case is being heard by en banc in the D.C. Circuit here in the next probably 30, 60 days, we think. And then finally, OCC FinTech proposal, it's worth a look as well. So with that, our time is up. I don't know if we have time for any questions or not. If not, we certainly do appreciate everybody joining us today, and we wish you a happy holidays.
Thank you, Brett. Thank you, Lori, Libby. That was great. We were really blessed to have you speak to us today. If you have any questions, I will be sending out their contact details here in the next few days. Please reach out to them directly if you have any questions. I'll also send out, like I mentioned before, a copy of the presentation and a copy of the recording in the event you missed some of today's presentation. With that, thank you again for joining us, and thank you again for presenting today. It was wonderful.
Thank you.
Have a great day.
Thanks.
Yep, thanks. Bye-bye.